Welcome to ACC 1103 Managerial Accounting. Today we're going to look at the budgeting process and which budgets are involved. Now you will see behind me, we are only going to focus on operating budgets, although not all the operating budgets are shown, and I will specifically talk about the sales budget and the production budget. So our budgeting process starts off with the sales budget. That is the first budget that will be completed. The information from there will flow through to our production budget. And from our production budget, that information will feed into three other budgets. One is our manufacturing overhead budget, then our direct labor budget, and then our direct material purchases budget. So let's focus on our sales budget first. Now, what is a sales budget? A sales budget is how much do you plan to sell and at what price. So the information from your sales budget is what is the anticipated or the budgeted number of units you want to sell, and this information will come from our sales and marketing department, and at which price do you plan to sell each of these units, or another way of saying it is each of these products. Okay, so let's put our theory into practice and let's look at an example. Our company is Magic Marker. It's a manufacturer of pens, and it will prepare its sales budget as follows. So for the next 3 months, October, November, and December, okay, from the sales and marketing department, it has received the following numbers. The budgeted unit sales, therefore the planned product sales of 5,000 for October, 20,000 for November, and 15,000 for December. Now that is good, but it's still not complete. We now need to say, but what is the price per unit going to be which we plan to sell? And in this illustration, the planned price is 12 dirhams per unit. So what we will do for each and every month, we will say how many units are we going to sell, multiplied by the price per unit, and that will give us our budgeted sales revenue. So if we just focus on October, we are planning to sell 5,000 pens. What is the price per pen or per unit? It's 12 dirhams. 5,000 multiplied by 12 gives us a budgeted revenue, therefore an anticipated revenue of 60,000. Remember, this does not have happened yet. This is just a plan. It's an estimate, and it may change, but we are going to work on this so that we can see how many units or how many pens should our company, Magic Marker, produce or make so that we can sell 5,000 units in October, 20,000 in November, and 15,000 in December. So this takes us to our next budget, which flows from our sales budget, and that is our production budget. So in our production budget, we are going to say how much units do we need to make so that we can sell the budgeted amount, like we have seen in our previous, let me just go back one so that you can see, in our previous sale budget. So I'm referring to that top line, that 5,000, 20,000, and 15,000. However, we cannot only produce that amount of units because it can happen that the sale is higher than anticipated. So companies produce what we call a safety stock. It's an additional amount of units which they keep in reserve for the scenario that if sales are more than expected, they have these products to sell to customers. And that safety stock which they keep in amount, that safety cushion, okay, it's in our ending inventory, okay, which we will see now in the illustration. So let's look at how does a production budget look. We are still with the same company. We are Magic Marker, all right. We have our sales budget already, so we know what is the planned sales for October, November, and December. So we start off our production budget by saying, what do we plan to sell? We plan to sell 5,000 units in October, 20,000 in November, and 15,000 in December. But now we must build in that cushion, that safety net that can catch us for if our sales is more than what we have budgeted for. Now, in this example, management has decided that they want to have an extra 20% of sales as that safety cushion. That means in practice, sales can go up by far more than 5,000. It can go up by 20% more than 5,000, and the company will still be able to supply the products to the customer. So in our next line, we have our budgeted ending inventory. And our budgeted ending inventory, if we read, it tells us in our example, note, October's budgeted beginning inventory is equal to 20% of October's budgeted unit sales, and December's budgeted ending inventory is equal to 20% of January's budgeted unit sales. So we can see in that last line that we have a safety percentage of 20%. So we say, right, for October, what is our budgeted ending inventory? It's 20% of our budgeted sales, which brings us to 4,000. For November and December, we do exactly the same. We say we have budgeted unit sales, and our ending inventory should be 20% of our unit sales, which is for November, 20% of 20,000, bringing us to 3,000. And for December, it's 20% of 40,000 as given to us. So now we can say, right, for October, November, and December, what is the total units we need? It's our sales units of 5,000 plus our budgeted ending inventory of 4,000, which is 20% of the next month's budgeted sales, gives us 9,000. For November, we add also the units we plan to sell, plus that 3,000. And again, where is that 3,000 coming from? Our safety net. Read that last line. It's saying it's 20% basically of the next month's sales. So it's 20% of 15,000. And December is given to us. It's our 8,000 units. So this is the number of units which we need each and every month. However, when we start our monthly planning, there will still be some units left over from the previous month which we did not sell. So we do not have to produce those units. It's already finished products. It's lying there. It's ready to make. So we must subtract those units which are already there, as we do not need to produce them. How do we know what's needed? Again, our note tells us very clearly. October's budgeted beginning inventory is equal to 20% of the months of October's budgeted unit sales. So 20% of 5,000 gives us our 1,000. For November, 20% of 20,000 gives us our 4,000. And for December, 20% of 15,000 gives us our 3,000. So what we do is we say, how many units do we need? And if we look at October, we said 9,000. Minus how many units do we have already made, which is ready to be sold onto customers? It's 1,000. That leaves us with 8,000 units for October, which we need to produce, 19,000 for November, and 20,000 for December. Now the information in this budget will now be used to see how much raw material do we need to purchase to make these 8,000, 19,000, and 20,000 units. How much labor hours do we need to spend in making these products each and every month, as well as what is our manufacturing overhead for making our 8,000, 90,000, and 20,000 units. So this is just briefly the first two budgets and how it flows from one to another and how it relates to the rest of the budget.